So as I said, we're going to look at task 1 of the internal controls mock that you should have got when you signed up. So can you see my screen if I actually press the share screen button? You should be able to see, it says task 1, an example to practice. I assume you can. Cool. Right. I'm assuming you can. No one's shouting that you can't see it. So this is the sort of thing you would expect to see in task 1. The first thing you see when you open your internal controls unit. Obviously, the question is not going to be the same. We don't get told the format of the questions in each task. We know if it's going to be human marked or automatically marked, and we know what it's going to be on. We don't know that it's all going to be multiple choice. We don't know it's all going to be drag and drop. When you signed up, you should have been sent a link from which to download it. But don't worry, I will send out, get a bit of paper. I will remind myself, I will send out this with the recording tomorrow. Well, someone else will tomorrow morning. But don't worry if you got it. It's multiple choice really, so you don't really need to sit there working out. We'll sort of just talk about why the answer is the answer. So here we've got one, a fill in the blanks type question. You've got the options to choose here. Remember, you can use the process of elimination if you know what 1 is, and then obviously that goes there. It's not going to come up again. And then, well, basically don't leave it blank. But in an ideal world, you would know. So financial accounting and management accounting differ mainly in respect of their, and we've got some choices. What makes sense out of the options we've got? We've got internal, external, that just wouldn't make grammatical sense, regulatory stakeholder, reporting focus, strategic or budgeting. So it is their reporting focus. It is what they look at. And, you know, and obviously down the line, who uses it? So they differ in their reporting. Now, forgive me, I'm trying to write with a big fat pen on an electronic screen. You will get drop-down boxes. Then you've got financial reporting is geared towards something audiences, management accounting is geared towards management decisions. So we've got with reporting focus. So we've got internal, external, regulatory, stakeholder, strategic, and budgeting. So financial reporting, that is doing, you know, financial accounts, the ones that go to Companies House, the ones that go to HMRC, that might go on your website if you want to do that. If you're a big company, sometimes you put your accounts on a website, which by that logic, it means it's going outside of the business. So this is for external audiences. So employees can see them, customers can see them. Companies House is free now. In fact, Companies House are going to have small company accounts. We get a P&L. That's going to be a great day where you can nose around there. And remember, Companies House is free. So all that you can see, any limited company that has to file accounts, it's all external stuff, is financial accounting. Whereas management accounting information is geared towards, obviously, management decisions. And what we look, it could be budgeting decisions, it could be strategic decisions, but the sentence is about their reporting focus. Who do we report to? So your management accounts, they go internally to managers, maybe directors, and they can see, you know, there'll be things like future forecasts, there'll be things like production budgets that you otherwise wouldn't want to share, future cash flow projects, a future NPV calculation. So it's stuff that you don't want external people seeing. You want external people to see the bare minimum, which is the financial accounts that go to Companies House. So this is our internal focus. Everyone all right with that? Cool. That's not a bad one for the first question in your internal controls exam, is it? Again, we've got match the boxes. Again, you can use the process of elimination if you don't know, but hopefully it's not too bad, these sort of things. It's all about the financial framework and environment that the business operates in, who's responsible for what kind of thing. So here we've been asked to match the accounting system output with the stakeholders who require this. Now, if I'm being honest, I think this question is back to front. So we've been given the directors on the left and the accounting system output on the right. So what we'll do, we'll match the accounting system on the right to the people who want it. So who wants an accounting system that comes out and they want to check that it complies with the standards out of 1, 2, 3, and 4? So we're going to match the accounting system output to whoever wants it. So out of options 1, 2, 3, and 4, who do you think is interested in the compliance with the standards? Yeah, 4. So professional accounting bodies, they want to make sure they will come in and they'll do like when I used to work in practice, they used to do like hot file reviews, cold file reviews. So that's looking at a file that you are, or a set of accounts you're working on currently, that's a hot file, or cold file is accounts that you've previously done, and the checking that you did them right. So the professional bodies, your regulatory body, will come in and check that you're complying with the standards. So the next one, planning and control information. So that comes out of our accounting systems. Who would be interested in seeing that out of 1, 2, 3, and 4? And you think, well, we've now identified 4, so we've got 1, 2, and 3 could be an option. Yeah, Paul is right. So planning and control information, that's going forward in the future. And that's, a control information is making sure everything's running right. That is the sort of thing directors would be interested in. It's sort of thing, well, it's their job to maintain, the smooth running of the business. Last two, we've got shareholders and lenders. Now, you can make an argument for both of these, but which do you think is the more likely person who's going to be interested in the annual reports and accounts? Yeah, so the shareholders, they probably don't see the, well, 99% of the time, they won't see the management accounts and things like that. So, shareholders doesn't have to be someone who owns a huge company or anything like that. It can also be the likes of you and me who own shares, a little bit of shares in, I don't know, Vodafone. Say, the chief executive of Vodafone is not going to give you the look at the management accounts and go, what do you think to that, when you've got 30 quid's worth of Vodafone shares? But what you will do is, as a shareholder, you look at the annual reports and accounts because you've got a vested interest in it. But that is all you're going to see, is the annual reports and accounts. As a shareholder, you get to go to the AGM if you're into that sort of thing, but you don't get too involved with the internal things. Now, shareholders might want to see a cash flow forecast. However, you have no right to see one. What you will get as a shareholder is the statement of cash flows, but that is looking backwards in the statutory accounts. If you've got, say you're going to do something in the future, and this is what our income is going to be in the future, this is what our expenditure is going to be in the future, you're not going to tell your shareholders. Now, some businesses will have shareholders who are directors who will see that, but a lot of businesses have shareholders who are not directors, who are like people on the street who've just invested some money. You're not going to show them your future forecast, because the next thing you know, if you're Vodafone, you've showed your cash flow forecast for Joe Blogs for installing 6G or something, it's in the public domain, and EE get hold of it. So you're not going to put anything sensitive like that in the public domain. But a cash flow forecast is the sort of thing a bank would be interested in, or a lender. Now, a bank and lender, obviously, they're not going to be sharing that, and they've only got to be using that because they're going to lend you money. So a lender would want to see, if they're going to lend you money, what you're going to get in, what you're going to expend, and can you afford to repay me? Now, a shareholder would be interested in the cash flow forecast if it's an owner-managed business, and that is only because the shareholder is also the director. But if the shareholder is just a director, they won't get to see anything internal. All they get to see is the annual reports and accounts, and speak at the AGM. Everyone right up to there? Cool. It's not too bad, is it? Next one. Which of the following documents would you expect? So an external stakeholder wants to see a record of all the assets owned by the company and all the liabilities owed by the company. So you've got 1, 2, 3, 4, 5. Firstly, which is the one that would show you what assets is owned by the company and what liabilities are owed by the business company? Yeah. So a statement of financial position is like a snapshot in time. It shows you what you own in all your non-current assets, current liabilities, non-current liabilities, and equity. A statement of profit and loss shows performance over time. You can see if the business is doing well, but you can't see what it owes. You can't have a business that's very profitable that owes loads of money. Conversely, you could have a business that has loads of assets that doesn't make very much money. Farmers being one. Well, at least my dad, anyway. So profit and loss doesn't show assets and liabilities, just shows performance. Statement of cash flows. Now, a statement of cash flows will show you what you owe in terms of cash or own in terms of cash in the bank, but that is it. It won't go that step further and show you your assets, non-current assets, and long-term liabilities and things like that. So whilst it's in the statutory accounts, it won't show you all the assets and all the liabilities. A statement of changes equity, that shows our reserves. Now, our reserves will net off against our net assets and liabilities, but that doesn't show us anything. It could be we've got loads and loads of assets and loads of liabilities, and they net off to a small amount, or it could be we have very few assets and very few liabilities, and they net off to a very small amount. You don't know from statements of changes equity. You just know the figure that the net assets and current liabilities balance off at. And lastly, budgetary control reports. Absolutely nothing to do with assets and liabilities, so it's not that. So it is statement of financial position, which shows you non-current assets, which will be broken down in the notes of the accounts between what's buildings, what's plant and machinery, what's vehicles, what's IT kind of thing. And it will also have the liabilities, trade payables, bank loan, overdraft, long-term bank loans, that kind of thing. Again, it's 1 mark, relatively straightforward question, but don't leaving them blank. Again, this is what coming back to roles and responsibilities of different stakeholders. So in this question, we talk about shareholders. And shareholders, remember about what do shareholders get to see and what do they not get to see, which is the one we're getting at. What do they not get to see? Yeah, the answer is budgetary control reports. And the reason why, all these 4 here, they make up the statutory accounts in a medium to large business. Even a shareholder, actually, in a limited company, should get rights to a full set of accounts, really. Although a small business doesn't have to do a statement of cash flow. But anyway, so a full set of accounts should include a statement of profit and loss, statement of financial position, statement of cash flows, statement of changes equity, and it also should have notes and disclosures to the end, but that's not a set part of the accounts. So that's why they all go in a full set of accounts. Shareholders will be given them, but what we won't be given is budgetary control reports. Cool. Now it's moving on to something a little bit more exciting. This is one of the new additions for Qualifications 22. Information technology. So this has been, remember, the previous standards debate was AAT 2016, so it came out in 2016. Therefore, they started writing it in 2014. You think how much technology has moved on in 8 years. So there's a massive emphasis on technology because AAT just brought it bang up to date. So here we're looking at data analytics. So what is data analytics? Anyone want to give me a quick one-line overview of what data analytics is? This is a new subject for Calls for Two. Data analytics wasn't in it before. Now, you don't need to know definitions verbatim in this unit. Well, you don't need to know definitions in life. Life's too short for that. You need to know what it does and what its goals are. Yeah, it's less of a calculation type thing, and so it's not really into just here's variance, here's a KPI. What it does, it analyzes a lot of data and takes in lots of different factors and looks at lots of different bits of information and analyzes it and uses it to predict the future, predict trends, and analyze behavior. It's not you spent £100,000, the budget was £120,000, you're 20 grand short. It's more technologically involved than that. It's more more useful than that, really. It does a lot of, like Paul said, analyzing historical data and then using it to improve future processes or future information, and for you to see the underlying picture, underlying trends and things like that. It's not just like a calculation, it's the sort of thing you couldn't do with a spreadsheet kind of thing. So which of the four of the following reasons are for the four reasons for finance to perform data analytics? Do you think data analytics will help you produce statutory accounts? No. We've been doing statutory accounts for donkey's years without data analytics, so that's not related. Data analytics, pen. How can an electronic pen with that ink? Next one, finding trends. I think I have mentioned this several times, so I'll probably give this away. Yeah, so what it does, it looks at loads and loads of data. It brings it all together, analyzes it, and then it starts looking at underlying trends, things going up over time, down over time, or cyclical, and it gets rid of anomalies. So if you've got lots and lots of data and you have like one outlier, you think, actually, if I've got 99 data points here and one data points there, it doesn't go, oh, let's move the average. It's just like, let's get rid of it. So it will look at finding trends. The next one, calculating budget variances. That's right. No, it's not. It's smart than that. You can do variances in Excel. You can't do data analytics in that. So we've decided those two not. We need to find three more. We've only got three left, but we'll go through them anyway. So yeah, next one, understanding customer behavior. It use loads, because one person, generally people are weird and people do odd things and everyone's different and things like that. But if you get lots and lots of people, you get them all together, you'll understand what the majority of people do. So do you get a big spike of Christmas cards in December? If you take one person at random, if you take like me, I'm shocking at sending Christmas cards, and you just use me as a data set. Like, no one buys Christmas cards in December because Nick Cragg doesn't buy Christmas cards. Whereas if you get like a lot of people, most normal people buy Christmas cards in December. And so use lots of data, you can understand what customers want. And obviously that's an extreme example, but it brings lots and lots of data together, and you can see trends of what people do, what they want, what they don't want, and helps you make more informed decisions. Reducing costs. Any reason why you'd use data analytics to reduce costs, or how you could use data analytics to reduce costs? Yeah, inefficiency. What sort of inefficiency? I mean, you can apply it to anything. There's lots of examples you come up with, but I'd like to see if anyone got one that you could apply to a workplace. Well, I've literally just made up a scenario. So first intuition, well, yeah, let's go. Reduce idle time. Yeah, I mean, you could use data analytics to analyze when is there a lot of idle time occurs, and then use that to think, well, actually, let's reduce the number of people we've got there. So for example, you've got a 5-day working week, and obviously some weeks you've got some people ill, some people on holiday, some weeks no one on holiday, and you'll have some weeks you'll have a bit of idle time, some weeks you'll have a lot more idle time. And you look at a week and you go, oh, we've got loads of idle time on Tuesday. Let's cut the staff on Tuesday. But that's taken from like 1 week. Whereas it might just be that 1 week, no one called in sick, it rained, so no one wanted to be on holiday, orders were low, and it's just right, that's why you got a lot of idle time. Whereas if you take the full year's worth of data and use data analytics, you'll get a far better picture of actually, it's not Tuesdays when we've got loads of idle time. It's like Friday afternoons or something because we've done all our orders. Or it could be, it's, Thursday afternoons, you've got a lot of idle time. And then Friday, you're rushing to get everything out before the weekend. And you think, actually, reduce the people working on a Thursday and get them working on Friday, stop paying them overtime. So things like that. You can use it to identify, like Paul said, inefficiencies, and then you think actually stop spending there or better off spending there at a lower rate. There's loads of things you could argue, kind of thing. And then lastly, analyzing opportunities. So, I mean, go back to our idle time scenario. If you identify you've got a lot of idle time on Thursday afternoon, say, and you can't move people hours around, you think actually, we can be confident more often than not, Thursday afternoons, we've got a bit of free time. What can we do with these people that are doing nothing that we're paying them for? And think, actually, let's do something on a Thursday afternoon. Don't know what. And it gives you that better information than if you think, actually, if you sat there with 52 weeks of payroll, analysing when what we paid, who was in, and what the timesheets and when people were productive, it'd be a nightmare, really. You wouldn't be able to do it manually, whereas data analytics will do that and give you a lot more information, because using a lot more accurate information, because it automatically uses lots and lots of data. Everyone all right with data analytics? You see, that's where it gets more interesting, I think. This is far better than the internal controls of what's a good password kind of thing. Yeah. Cool. Right. Which one of the following, I'll ask you, but then I'll go through them all anyway. Which one of the following is an effect that data analytics would have on decision making? One of these, and what effect would it have on decision making? Decisions more slowly, future information, decisions based on little evidence, and small number of factors that are considered. Any other advance on Paul's number 2? Yeah, it is number 2. But we'll go through them. Decisions made more slowly. No. You've got loads and loads of data, and rather than one person going through, or several people going through and manually calculating, churning out stuff, it's done automatically, so it's a lot quicker. And like I mentioned before, it can analyze trends and behavior, and from that you can use it to predict the future. So if you know the vast majority of people buy Christmas cards in December, you can ramp up your production in December rather than just taking 2 or 3 people who one of them might not buy Christmas cards in December, and it just affects your whole data set because you have to do it manually. Next one, decisions based on little evidence. This is not true. You can use loads and loads of evidence. The more evidence, the better. It gives you a lot more accurate figure. So if you had, say, for example, you had 10 people you were, using the data in your data set, and one of them does something weird, that skews 10% of your data set. So you might think, well, actually, only we're going to sell 90% of this or whatever. But then actually, if that's just an odd person, and you expand your data set to 100 people, and in fact, out of the 100, only 2 of them do something weird, you can be a lot more accurate that 98% of people will do this. So the more evidence, the better. It will stop outliers having such a big effect if you do get one. So it gives you more accurate information. And then lastly, only a small number of factors are considered. No, you can take in loads of different factors. So it's not just demand. It can be, demand, price paid, product that they buy. Christmas, do they want it quickly, but they want to buy something expensive, versus, looking at just what was our sales in Christmas. It's a lot more information. You can take in lots of different factors, and again, make more accurate decisions. Cool. Last little multiple choice one, I think it is. Last radio button, as we call it in education. Data visualization may be best used for the finance department to do what? Now, remember, it's data visualization. Which of these is going to be the best use of this? Or what more likely use data visualization for? Yeah, it's going to be narrate financial performance. So that might be a graph, a pie chart, or something like that, a line chart, so performance over time. So you might say, oh, this is the profit for the year, and then you put a trend, or you put a graph in saying, but this is the trend over time, and you can see it going up. Whereas if you see numbers, it's quite hard to see that you were here one year, here another year, and here another. You can see it's increasing, but when you put a nice graph in, you see how steep it is, and it helps you more, understand the numbers better. Whereas it's more about analyzing information that's happened. So it's not going to improve financial planning to a degree. It's more analyzing what has happened in the past, and you can make better decisions on that, but it won't do financial planning for you. It's not really going to identify deficiencies. You can show inefficiencies, but it doesn't really give you anything visual. I mean, what would you do with inefficiencies of bar chart? It's not the same as what it's meant to be. Is narrating, adding extra information, adding extra context to financial information, and prevent fraud. It's just not going to do it. Not going to do it. Again, it's a very short question. It's worth 1 mark. Sort of thing. Go in, put something down, and move on in life. Cool. Are we all right to there? Because now we're going to move on to another subject, which is a new addition for AAT. I think it's a great introduction for AAT. It's the sort of thing where the industry's going, and everyone needs to know awareness of what it is. Cool. First one, automation is more complex than artificial intelligence. Do we think that's true? Do we think it's false? Yeah, but what I'll go through why. Now, automation is we do this, therefore we do that. Or we do this, then we do this check, and then we do that. And it is what it is. Whereas artificial intelligence is something that it gets different inputs, and it knows how to deal with it in different ways. So automation is very sort of programmed and everything, whereas AI can adapt to different situations. It's a lot more complex. And it's a bit like, simple things like Amazon. When I go on Amazon, my Amazon homepage will look different to yours because it knows who I am and it knows what I'm interested in, and it'll analyze lots of data, and it will then give me what it thinks I need on my previous things. Whereas automation is things like, I bought this, therefore I might be interested in that, because they are similar products. Whereas AI, it knows me, it knows what I look at, it knows what I'm interested in. And I have quite eclectic things on Amazon. Because my wife and kids use Amazon account, actually, it's all a bit weird. But it uses a lot more data than just automation. Machine learning. Does this require vast quantities of data? Yes or no? And I'll go through what machine learning is once we've got an answer. Do you think machine learning requires vast quantities of data? Well, let's put it this way. Is machine learning better with lots of data or less data? Yeah, definitely more. The more data that runs through machine learning, the better. So does anyone have smart speakers in the home? Now, I've got Google smart speakers. I've got quite a few because I'm a Sado, and there's a website I can go on and I can listen to every voice command me and my family have ever made on the smart speakers, which is a lot. And so there's an absolutely massive amount of data that Google collect. I think I've signed into it, collect for their voice assistant to analyze, use, and improve itself. So it uses data and then it acts on it, then it improves what it does. So there's times when my phone does it. It says, occasionally pops up, you'll ask it something, it goes, were you satisfied with the result? And then you click yes or no. And then it goes, right, that data point, that data set used in this way gave a satisfactory result. Let's down, and then it improves the accuracy of it. It's a bit like when you type in, I want to go to somewhere else on Google Maps, and Google Maps analyzes where you are, where you're going. It takes into different accounts of traffic, something or other. Then at the end, it will go, did this get, did this satisfactorily get you to your destination? And you click yes, and you click no. And then it starts, and it goes, right, that was the right way of doing it, or it wasn't. And so the more data machine learning can collect, the more accurate it can be, because it builds on it and it effectively learns, hence the name. Which, I'll be honest, I've sort of very much segued into the next answer. It does. It's constantly learning as machine learning. It's not, this is it, and this will always ever be. It will get more accurate. It will get better. And it's always learning. And the more data, the better. Next one, AI can be used to make decisions. True or false? My coffee cup. Yeah, it's true. AI is something that you create. Well, I don't create, obviously. You create, and it can make decisions on a wide variety of inputs that you have never envisioned, but it knows how to deal with it. And so you use AI to, you cannot anticipate every single thing. That is why you would implement AI, because that would, you could, like, for example, this is a good example. I'm a bit of a geek. I watched a program on Mars Moonlanders, not Mars, yeah, Mars Moon, no, obviously not Mars Moonlanders, but Mars rovers. And there's a 6-minute delay between sending a signal between the Earth and Mars. So it's like, oh, what do I do here? I'm falling off a cliff. That's why it has AI on it to think, I know what to do. I've never envisioned this particular scenario, but I can deal with it because I can't rely on sending a 6-minute signal there and 6-minute signal back. So it can deal with things that it's not programmed to do. Because can you imagine writing a program to deal with every single possible scenario you could ever meet on Mars? It would have been ridiculous. So AI is used for it to analyze, look what it's got, and then make the best course of action based on the information it's got. So AI is used to make decisions. Next one, automated process should result in fewer mistakes. And when I say automated, fewer mistakes than a person doing it. Yeah, a simple example is someone buys something on a website, the person's details, everything are automatically put into the CRM. The CRM then goes straight to the inventory thing, and the inventory thing then ships it, and then the Amazon drone drops it at your house or something. And if no human gets involved, it's a lot more accurate than relying on someone typing it in and making the spelling mistake and send it to number 22 rather than number 2. Next one, controversially, automation, machine learning and AI can lead to job losses. True or false? I don't know if someone got an agenda when they wrote this question. True, it's like the self-service tills in Tesco's that never work. Right, algorithms will always make fair and unbiased decisions. Do we think that's true or false? That is it is false. There's lots of good examples of this. A good example of this was Google Photos. Google Photos, it's got an algorithm that it takes the information that the camera takes, and it doesn't go, well, that's the information the camera takes, here's your photo. It takes it, it analyzes it, and it goes and like improves it and does this and does that, and then it gives you what it thinks is a really good photo. And a few years ago, it used to have an issue with darker skin tones, and it couldn't handle it. And so people with dark skin tones didn't get good photos because the algorithm couldn't or wouldn't deal with it particularly as well as it could. So now they made a big song and dance about it the other year about, we've improved the algorithm so it doesn't, it's not biased against certain people with things like that. So that's one example. I'm sure there's plenty more. There's lots of things there. You plan it, you write an algorithm, but obviously it's doing things itself, and there will be things in your algorithm that you didn't anticipate or you didn't envision, which an algorithm is not machine learning. An algorithm is something you've written and then you'd improve it. As machine learning, you go to that. Next one, data analytics only uses financial information. True or false? Yeah, Paul, police facial recognition, the same problem. I don't just make it up. Yeah, this is false. There's loads of things you can do there. You can use, people's behavior. You can use, surveys. Were your customers happy? Things like that kind of thing. So it's not just financial stuff. Next one, dashboard is an example of data analytics. Do you think that's true or false? Now, example of this is, let's say, the home screen on Xero. The answer is there may be data analytics behind it, but the actual dashboard itself is the data visualization of what you can see. So it might have data analytics analyzing things and coming up with stuff and come up with data, but the dashboard is what you log in and see the information. So that is the data visualization bit. And lastly, cloud accounting reduces the risk of data loss. But the other thing I would also say, if you do get a question of cloud accounting eliminates the risk of data loss, the answer to that is obviously not true, because you can never eliminate every single risk, but it does reduce the risk. Amazon Web Services generally doesn't go down, whereas you can lose a pen drive in the car park. Or remember your 3.5 inch or 3.25 inch floppy disk that just gets corrupt, and you're like, well, that's my only copy of it. I've lost all my data. I think so. Cloud services does reduce the risk of data loss. Cool. Any questions on anything we've covered this evening? What do we think to that as a first question if you went into your internal controls exam? Do we think that is manageable or achievable? You could have a fair crack at that? Do you reckon full marks or near enough? Yeah, not bad. Really? Something. That was nice bit in PDSY. Yeah, so next week, it's me. I'm doing internal controls for the next, goodness knows, 5 weeks, I think it is, which will actually get us through the entire exam. So we're going to move on to task 2. And as we move to the later tasks around more written stuff, it's more interactive, more discursive kind of thing. But that's one where you hope you would do really well on it. Really, it's not a bad question.